had a little time to process earnings season, I want to circle back to the turmoil in the social media space. Twitter and Pinterest reported terrific numbers, and so their stocks surged higher. Meanwhile, Facebook and Snap posted seemingly disappointing numbers, and their stocks got hammered. I think all four of these names are worth owning. Let me explain, because social media has too much going for it to ignore them, and there are not that many social media companies out there. There's clearly been a shakeup in the group, and we need to update our power rankings. And you've asked for this, and we're going to give it to you. After Facebook reported at the end of January, its stock lost nearly 10% of its value over the next 2 days. Snap plummeted almost 15% in a single session. For a few days, it really looked like this whole industry was in real trouble. Then Twitter rocketed up 15% after we saw the results earlier this month, and then more than 9% the day after that. Well, they changed the narrative.
House of pleasure.
So what's separating the winners from the losers in social media? Why don't we just start with Facebook? After putting a series of strong numbers last year, the stock rallied hard at the beginning of 2020, surging to new highs. That ratcheted up expectations. So when Facebook delivered what I thought was a pretty good quarter, it wasn't quite good enough for Wall Street. The company posted a top and bottom line beat, same as usual. But the beat was smaller than what we'd gotten accustomed to seeing because Facebook had been such a juggernaut, except for last July in 2018. Their user metrics were merely in line. And the company told us they would be discontinuing those stats for Facebook, though not Instagram. Well, this kind of thing is typically viewed with great skepticism. Why not give us all the numbers if the numbers are good? It didn't help that Facebook's revenue guidance for the next quarter was less than stellar. Management plans to spend more money than Wall Street was expecting. So the real problem had little to do with the quarter and everything to do with the fact that Facebook stock had just kept moving up and moving up and moving up and was clearly priced for perfection going into the quarter. Anything less than perfection was going to spark a sell-off, and that's exactly what happened. Long term, I remain a believer in Facebook. It's a gigantic position for my charitable trust, which you can follow along at actionalertsplus.com, which is part of the club. Albeit we purchased the stock at much, much lower levels and have just owned it for a long time. How about this social media loser that did surprise me? And that's Snap. This company, the parent of Snapchat, came public in 2017, very quickly became a total dud. We called that right. But over the course of last year, it looked like Snap had gotten its act together. They released a much improved version of their app for Android, and the users were coming back in droves, bringing the advertisers with them. And that's why I recommended Snap late last month, although I also told you not to put a full position on until after the quarter, just in case the stock got slammed. See, I had been concerned that Snap had caught too many upgrades going into earnings. Well, that raises the bar, making it harder for any company to beat the expectations. Well, sure enough, Snap delivered a small revenue miss with modest earnings beat. Tiny. But what everyone fixates on is the guidance. Management said they'll be losing more money than expected this quarter because they're investing more heavily in the business. In response, the stock got completely eviscerated. It's still down $3 from its high. That said, you know what? I'm telling you to buy it. I think you're getting a great discount from where it was. Someone the other day on Twitter asked me right here, what do you do with it? And I say, you can buy it. I do not think it is too late, all right? Now, you know what's funny? The two social media winners, Twitter and Pinterest, also told you they would be investing a lot more heavily in their businesses going forward. But ironically, instead of being punished, their stocks were rewarded. What's going on here? What sets them apart? Right, some of it is the expectations game I just mentioned. Twitter's stock plummeted after the company reported its previous quarter in October, and it hadn't fully bounced back by the time the next quarter rolled around earlier this month. By the way, I told you to buy this one into weakness. That was right. When Twitter reported again earlier this month, they knocked it out of the park with a juicy revenue beat and an acceleration of monetizable, sorry. What is with me today? Monetizable. What am I doing? All right, what is that? Okay, it's Friday. Monetizable. I mean, it's Friday. We'll take all this out when we do post-production. Okay? I'm talking to my executive producer. She knows it's all going to be gone. She's going to monetize me. Monetizable? What is it, like Matisse? Monetizable. I mean, honestly, okay, now we've completely lost our train of thought. Now, that's not what I wanted. All monetizable daily average user growth, up 21% versus 17% in the previous period. Wall Street wanted to see 147.6 million daily average users. They had 152 million. Now, that's a nice surprise. Twitter keeps improving its platform, making it more intuitive and limiting the visibility of potentially damaging content, which you know I love because I'm a heavy user of Twitter. That strategy is working. It also costs money, though, and the earnings came in weaker than expected. But Wall Street was willing to look past that. We saw the same thing in the guidance. They're forecasting fabulous sales numbers but weaker profits because they need to invest so heavily in the platform. Investors couldn't forgive this kind of thing from Facebook or Snap, yet they were cool with it from Twitter and Ned Siegel, the CFO, whom we like so much. He went not just because he went to Georgetown. That does factor in, though. Hoya Saxa. I think it's because the expectations for Twitter were lower, and also because the company's proven it can overcome adversity. Even if this quarter wasn't consistently better than expected, well, it was certainly Naboth, not as bad as feared. Remember Naboth? I like that. Pinterest has a similar story. Here's a company that came public last April. Its stock initially ramped to the mid-30s, but then it got pulverized. The last quarter in October was widely considered disappointing, and the stock ended up sinking to the high teens at its lows in December. That was painful, because you know I liked it. After that, the stock started to bounce, so Pinterest had a bit of momentum coming into the earnings, though it was still well off its highs. That's important. Then the company delivers a truly blowout quarter, 4-cent earnings beat off an 8-cent basis, substantially higher than expected sales, and fabulous global monthly active user growth of 26%, key metric, and terrific average revenue per user, also good metric. Even better, Pinterest gave us bullish guidance. They monetized. What's driving the strength? The company rolled out a new version of their app for Android. Isn't it funny? Because that's also what happened with Snap. It's like people always underestimate how important it is to have something for Android. They have faster download speeds. They're seeing more major growth in video. They launched a More Ideas function that shows users digital vision boards that they might be interested in. Really, though, Pinterest is giving investors everything they want. Strong revenue growth with steadily rising profitability. No wonder the stock ignited after the quarter. Stock surged to $26 2 weeks ago. It has since cooled off back to 22. And you know what? I think it's kind of nuts that it went down that much, but we know what's happened in the market the last few days. Meanwhile, the two losers, Facebook and Snap, have already started rebounding, which makes a ton of sense to me. You know what works in a world where people are afraid to go outside because of the coronavirus outbreak? Social media. If you can't interact with your friends in person, at least you can interact with them online and show pictures of their dogs. Now, incredibly, Facebook's the cheapest of the bunch, selling for less than 19 times next year's earnings estimates. 19. It's just that like some banks sell at that. And that's in part because the regulators have a target on Facebook's back. Still, I think Facebook's the safest social media play if this market keeps getting hit. It's inexpensive. But the bottom line, you want to know the difference between the big winners and the big losers in social media this past earnings season? It turned out to be about Mrs. Haversham. It was about the expectations. As I see it, all four of these companies are doing well. None of them had perfect results, but Facebook and Snap had run going into the quarter, while Twitter and Pinterest had sold off ahead. So Facebook and Snap got pulverized, while Twitter and Pinterest caught fire. You get it? Right now, I like all four. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.